So there's so much talk going on about, are we headed into a depression? It seems like so many people are saying it's already for sure clear. You saw Jerome Powell, chairman of the Fed, say we are in a recession. And so today I'm really excited to bring with you Rick Rule. Rick Rule is one of the most famous, not only gold investors and mining investors in the world, but overall natural resource investors. He's a CEO of one of the largest natural resources companies in the entire world. Someone who is someone I look up to a lot, and I'm really excited to have Rick here today because not only can he talk about how to prepare for a recession or a short-lived depression, but how to profit from it and can really help us detach from our emotions. You know, that's something that I think I learned a lot from you in the short time you and I hung out a few weeks ago, Rick, was just learning how to try to do a better job of detaching my emotions from everything. So thank you so much for being here.
Thank you. I'll do my best to live up to that kind introduction.
Well, you're in trouble if you don't. So give me your take on what's going on right now. Obviously, weren't really expecting a coronavirus meltdown. Just give me your take on everything going on in the economy. They just passed a stimulus. Just want to know, someone like yourself that's been an astute investor that's made, probably for your company, you've probably made hundreds of millions or billions. And for yourself, I'm sure you've made yourself many, many tens of millions. I would love to know your thoughts on everything going on.
Well, that would be a long topic. The truth is that the coronavirus, I think, surprised everybody. But a black swan, by definition, is something that surprises us. The lesson, I think, is that as investors and citizens and taxpayers, we've become increasingly complacent and increasingly trusting in collective solutions to what were historically individual problems, which is to say, to quote Nassim Taleb, we have become fragile. The response is that we need to become, as individuals, anti-fragile, because to the extent that we are relying on each other to bail us out of our individual circumstance, we will always be fragile. So what do all these words mean? They mean, as an example, that we have been through 10 years of an economic recovery, or a little more, since our last liquidity crisis. And this recovery, first of all, in a historic sense, is very long of tooth. Economic recoveries don't usually go 10 years before you go into a recession. We have decided as citizens, as voters, that we don't want to have recessions anymore. And we believe that our collective wants are bigger than markets. The problem is that markets are bigger than we are. By forestalling a small recession with liquidity, what you do with liquidity is you forward shift demand. So demand that you would have enjoyed in 2012, you enjoy in 2010. And then to make things go forward into 2011, you have to steal demand from 2014. We've done that for 10 years now. And there's only so much forward shifting of demand that we can do. We have already also manipulated interest rates much lower than they normally would have been if normal market forces were to play. We have artificially low interest rates. That's a different way of saying that we have voted as citizens for the spenders to steal the benefit of savings from the savers. Now, this is perfectly easy to understand in a democracy because spenders are numerous and savers are scarce. The difficulty is that these artificially low interest rates generate economic activity that is unsustainable. And we're seeing that right now. The whole circumstance with too much debt and not too much non-productive investment, in fact, too much confidence, means that the situation is fragile. and exposed to a black swan, the coronavirus being the black swan. In my own mind, while coronavirus is certainly a serious circumstance, the level of economic dislocation that the entire world has experienced is problematic. What makes it more problematic is that it happened after a 10-year artificial bubble, and it happened to systems and people who were unprepared to cope with it. The truth is, I think, that whether we want to or not, and whether we forestall it a little bit or not, we're due for a bit of a reckoning. We're due for a little bit of a reset. Markets, unfortunately for most people, work. And this market is in the process of working right now. That will be unpleasant for people who are unprepared for it and do not become prepared. And your listeners are going to hate me for this, but I'm going to say it anyway. Market dislocations like this, recessions, depressions, bankruptcies, don't make the world in the aggregate less rich. The fact that an oil company goes bankrupt doesn't make the oil disappear. It doesn't make the wellhead go to wellhead heaven. It doesn't vaporize the pipeline. Similarly, in technology companies, the bankruptcy of a technology company doesn't evaporate the patents or the intellectual capital. It just makes them change hands. The people who lose them don't like this circumstance. The people who gained them probably feel a little better about them. The truth is that these are normal and natural processes. Our actions have consequences, and unfortunately, we're feeling the consequence of 10 years of artificially good times. I joke that we have asked Congress to cure our rum hangover by giving us a long shot of vodka. And while it works for a couple hours, ultimately, as you may know, I certainly know from my youth, financing a hangover with more alcohol is ultimately not a very smart thing to do. These bailouts, these additions of liquidity are financing a hangover, a liquidity hangover with liquidity.
It sounds to me more like we are fixing a hangover with cocaine rather than just another shot of vodka, but I think we're on the same par there. So when you and I met a couple weeks ago, I started crying in front of you, and I had never met you. It was kind of embarrassing. And the reason I was crying is because I feel really bad for everyone. It sucks. They just released the job reports today, and obviously, 75% of people living paycheck to paycheck. So a lot of people are screwed. And so I guess it's bleak and it scares a lot of people, but there's also is a lot of opportunity. You discussed wealth changing hands and the opportunities that are still available, even though they've printed so much money. It's artificially low interest rates. There's no way they're going to be able to raise it. What are you looking at, and what is your advice to an astute individual that is looking to preserve their capital and potentially grow it as well?
Well, the first thing is, if you are not anti-fragile, become anti-fragile.
How do you do that? I don't like it when you say that.
Well, in periods of time when there is a crisis in confidence and trust, the asset that you have to have first is cash. Have cash and have gold, both. And hope, as we discussed 2 or 3 weeks ago, that the gold price doesn't go up too much. Gold is insurance. And any circumstance that causes your insurance to pay off presupposes that something bad happened.
Yeah.
If you think about gold like insurance, you get paid auto insurance, it means you had a wreck. Life insurance means somebody died. If the gold price goes up, it means that the system of collective trust is in peril. And while I believe it deserves to be in peril, I would rather live out the rest of my years in less interesting times. Similarly, with regards to cash, many people say, Rick, US dollar savings lose purchasing power every year. And that's true. Losing purchasing power is the option price that you have to pay to have liquidity. And liquidity gives you both the means and the courage to take advantage of volatility and market dislocations rather than being taken advantage of. So the first thing to do is to become financially anti-fragile. Have cash, have gold, and begin to manage your emotions. There will be, in the course of this year, abundant investment opportunities. Let's talk for a second about what a bear market is, because I'm going to propose to you that what a bear market is a sale. When you and your wife go to the store to buy a coat, if the store on the right has a coat that you like, it's appropriate to the winter and things like that, and the coat is $300, and you go back a week later and the store on the left has the same coat for $150, that is, the coat is half as expensive, you like it twice as much. But for some reason, when we buy a stock for $20, or when we think a company is worth $20, and then the stock starts to sell for $10, we like it half as much. Now, the truth is, if nothing has changed with the underlying business of the company, if it's an oil company and the oil well is still there, whatever it is, if nothing has changed and the price falls by half, it's arithmetically twice as attractive. So making your mind anti-fragile as an investor at the same time that you've made your personal balance sheet anti-fragile with cash and gold is how you don't just survive this circumstance, but rather you thrive. The third thing to recall, and this is very difficult for people your age who haven't experienced it as much as I hate to act like Father Time, but all generations believe that the government should do something, that the government should fix it, that there are collective solutions. Your government is the problem. It's not the solution.
Yes.
Don't look to everybody else to solve your problems. Look to yourself and your community. Look to your customers. Look to your partners. Look to your shareholders. Look to your own community. Solve their problems. And by solving their problems, you'll solve your own. I don't know if you've looked at some of the details of this $2 trillion bailout that was proposed yesterday. It's a virtual Christmas tree of spending proposals, goodies for politically connected parties close to Democrats and Republicans in the House and Senate. This isn't about a bailout of poor people across the length and breadth of the United States. This is stealing $2 trillion from future generations like yours and giving it to pet projects of old politicos who look like me. It is really, truly, as Mencken said, an advanced auction of stolen property. So part of being anti-fragile is understanding that government doesn't have a solution because government itself and the belief in the collective is the problem. The one who is going to solve your family's financial problems in the future is you. And any belief that you have that isn't 100% consistent with that is harmful.
That's great. That's great. So let's discuss that then. I liked what you just said about keeping cash. It was ironic because, I came into you to see you and I said, I dumped $1 jillion here and I want to dump the rest here. And you said, don't do that. You need to keep some money. And ironically, 2 weeks later, all this stuff happened. So that was pretty ironic. And
I'll send you a bill for that great advice.
So then second, you said gold. Third, you said emotionally preparing yourself. And one of the foremost ways to do that, essentially how I interpret it, is taking responsibility for your own financial situation and realizing that you alone are the savior to it. Let's discuss in more depth how, at least in your own mind, you're intending to do that for yourself. Or if you were my age and you had some cash available, or even if you didn't, how you would be preparing for this situation and intending to make money off of that. Whether, you talked about things that are going to be on sale soon. Are we talking about just gold and silver mining stocks? Are you looking at other sectors? How are you personally preparing or advising people to consider preparing in order to protect and preserve and grow their purchasing power?
Right now in the bear market, as I understand it, global equities are off about 30%, which is to say that we're in a 30% off sale, which is good. But my suspicion is, however, it gets better because we've been in a 10-year-long bull market. I'll give you an example of this. And I will answer the question, I promise. I'm giving you an answer. I believe 3 times since I've owned shares in Warren Buffett's company, Berkshire Hathaway, that the company has declined by 50% or more in value, in price, over an 18-month time frame. Every time that an investment of yours declines by 50%, it's unpleasant and it's unsettling. Yet, if you look at the stock chart of Berkshire Hathaway going back 40 years, you can't even see those 50% declines. So you need to begin to prepare your mind around 2 disciplines. One is that the price of something is not often connected to the value. In other words, the fact that Berkshire Hathaway fell by half in price didn't equate to a 50% decline in value. Buffett himself says that the market is a voting machine in the short term and a weighing machine in the long term. I don't know how you feel about the way people vote, but I feel they normally vote very stupidly. What that means is that there are disconnections in bull markets and bear markets between prices and value. And you need to develop a skill set as a young person to get a sense of what something is worth rather than just what it is selling for. So begin to look at companies, to begin to look at stocks as fractional ownership in a business, and learn at least the rudimentary ways to determine what the business is worth before you worry too much about the share price. Let's say that you're a customer as a young person of Apple Computer, and you own an iPhone, and you own an iPad, and you think that the value offered up by Apple to you as a consumer, and that the likelihood that with Apple's technology and user base that they will be able to continue to do this gives them a durable competitive advantage. And let's say that Apple is trading at, let's say that in a normal market, Apple has been trading at 15 or 16 times cash flow, and it's now trading at 10 times cash flow. If you think that Apple's technology and Apple's user base, Apple's ability to generate utility for users like yourself has ongoing value, and you have a bit of an expertise because you are a consumer, a user, then rather than being alarmed by the deterioration in the share price, you should look at the fact that the value remains intact while you are able to buy it for less on the markets. The second thing that you have to prepare yourself for is that your time preference doesn't matter. It matters to you, but it doesn't matter to the market. All of us want certainty. Unfortunately, certainty is very seldom available. The only thing that's available to us are probabilities. And while we want price appreciation or something in the short-term time frame, all of us want clarity by Easter. The problem is that the market doesn't care that we want clarity by Easter. But markets work in 3-year and 5-year and 10-year cycles. And the markets are completely disinterested in our time preference or our preference for certainty. So wrapping our minds around the fact that our emotion wants something that we can't have means that you need to disregard the narrative that's comfortable for you and pay attention to the narrative that's available to you. A very important thing for a younger person like yourself to do is what I did ask you to do, and I believe what you did. To be an investor, start by investing in yourself, in your own education. Knowledge is something that for sure can be lost, but it can't be stolen or taxed away. And so investing in your own knowledge. In your case, I asked you to read The Intelligent Investor by Ben Graham, with particular attention to the chapters on margin of safety and to Mr. Market. And this discussion this morning has been mostly about Mr. Market. And I would urge all of your listeners, but particularly the young ones, to read that book. Don't just buy it and leave it alongside your bedstand. Buy it and read it. In fact, you don't need to buy it. You can go to the library and borrow it. It's free. And it's the best investment book ever written relative to the effort required to read it. And then read another book. Read a book called Economics in One Lesson by Hazlitt. That one book will disabuse you of all the idiocy that they teach in university around economics, which is total pablum. Economics in One Lesson tells you how the world works, as opposed to the way that you wish it worked or the way the politicians try to make it work. Having suffered through those two books, read a third book. Only if Intelligent Investor was interesting to you. If it was interesting to you, read a book called Securities Analysis, also by Ben Graham. Any investor who reads that book and employs the methods described in that book will become rich. Will become rich. Not in a year, not in 2 years, in 20 years, which is the amount of time that it takes. And then finally, having read Securities Analysis, the granddaddy of all investment and social wisdom, a book by Ludwig von Mises called Human Action, which explains the way that humans act. It explains what volition is, and it explains the direction of society as a combination of many individual human actions. The most important thing that a young person can do with their time to prepare to make themselves anti-fragile is to read those 4 books. If you read those 4 books and employ the lessons, you will be a success, in a financial success, in your life. And I'm not suggesting in the course of this discussion that every measure of success is financial. There are many measures of success. All of them are important. I'm just unfortunately not an expert in those things. I prefer to talk about things where I believe that my advice has some value.
So the Human Drive and Values book is also a great self-defense tool as well, because it's so large, especially during a quarantine situation. So got that going. The second thing that I found was so bizarre, having me read these books, was I'm reading them, and this was just before the bottom fell out from the Corona situation. I'm looking at it, and every single thing that Benjamin Graham warns against is not only prevalent, it is the entirety of the market and the psychology of the investors today. And it was like, almost like gave me like the goosebumps, because it's so, I'm like, this is really weird, and then the bottom fell out a couple weeks later, which made it even weirder for me.
Well, it's useful if lessons that you come to understand intellectually manifest themselves for you so that you come to understand them emotionally. You could read Ben Graham's discussion of the mob reaction in Mr. Market, and you could understand it in an intellectual fashion. But if you have the extraordinary, I guess you'd call it advantage, of having it occur in real time, the lesson, it becomes much clearer. And you had, I would say, an extraordinary example of something happening in real time. It was not, by the way, something that I anticipated on your behalf.
No, you didn't? Okay. I thought you planned this whole thing out for me. So how are you deploying your capital right now? And are you? And if so, what?
I'm emotionally very, very stable. I am very good at handling volatility, and I'm also very good at handling loss. I'm not risk averse because I'm an experienced risk taker. So I am deploying capital now, and I will be sanguine. And that's not to say happy, but I will be sanguine if some of the positions that I buy decline another 25% in price in the next 2 or 3 months, because I'll buy more.
Are you talking about mainstream multi-caps, or are you talking about the mining space?
What I really understand myself is natural resources. And so I am buying particularly precious metal stocks. I believe that the policy response to the condition that we find ourselves in, even lower interest rates, more debasement of the currency, means that the gold price ultimately will do, unfortunately, very well. After that has happened, the gold stocks will do well. But I've learned in the course of my life, when there are big discrepancies, panic-induced discrepancies between the price of assets and what I consider them to be valued at, if there's a big delta between price and value, despite the fact that the delta might widen out, I'm well advised myself to begin to take advantage of that. Warren Buffett describes this well. He said, you should never buy a share of a company if you didn't understand the company's affairs well enough, that should the share price decline by 50% in the 2 or 3 months after that you bought it, you wouldn't be delighted because you could buy more at a greater discount using the knowledge that you had already acquired. Now, sadly, in my career, I've been tested with this a couple dozen times.
I was right away. I mean, you know me. I put over $500,000 into precious metals just before the Corona situation. And so to see it go down, it tested me exactly on that. And I did buy more, and I am going to buy more. But that exact scenario as a first-time investor occurred to me when there was the liquidity sell-off.
And it's great that it happened to you early in your career, first of all. And it's great that early enough in your life, you have the ability to learn the lesson and then first survive and then subsequently thrive. That's an absolutely wonderful set of circumstances. I'm not kidding. I'm delighted for you. The fact that you get tried in the course of being right gives you the courage to be right again. Do you understand where I'm going with that?
Yeah.
It's important that you understand that. Let's segue this discussion for your listeners' benefit into precious metals, which is a lot of what you and I described when we were together. Many people who haven't had as much experience in markets as I misunderstand the course of the protection that precious metals offer. And they believe that precious metals respond directly to dislocation. That isn't true. In a liquidity crisis, a trust crisis, every asset that can be sold is sold, and gold is no exception. So in the liquidity-driven sell-off that occurred, gold sold off too. Gold sold off for three reasons. The first is that there were about $60 billion in leveraged long commodity trading accounts that held gold, some with leverage as much as 30-1. When credit became unavailable overnight, that got sold. The sale wasn't made by the portfolio manager, it was made by the margin clerk. The second is related. Gold that was held in accounts that were generalist accounts, but were also leveraged. In order to deleverage, sales took place on anything that had a bid. Gold is wonderfully liquid, so it was sold too. The third thing that happened is some individuals who might not have had margin but wanted cash sold gold to raise cash. This is with past liquidity crises that we've seen in the last 40 years. It isn't the liquidity crisis that causes the gold price to go up. It's the policy response to the liquidity crisis. You're seeing that now.
Elaborate for someone that still doesn't totally grasp why what you're saying and why people like you and I are so bullish on precious metals as a result of it.
Your government is going to deal with this crisis by quantitative easing, which is to say by conjuring up $3 trillion or $4 trillion or $6 trillion from thin air and putting them into the economy. In other words, they're going to debase the currency. Now, from a young person's point of view, what you're really doing is you're subsidizing the mistakes of old people like me, and you, yourself, your generation, are footing the bill, because this ultimately debases the currency and adds to the national debt. The thing that makes gold do well is a lack of faith in the purchasing power, the ongoing purchasing power of savings. Let's look at the US dollar just for fun. Most of your listeners, I take it, are American. At the federal level, we have $22 trillion, and your listeners should write this down. That's 22 with 12 zeros in full recourse debt. People look at me with their eyes glazed when I mention this number because they don't know what a trillion is. And I don't even know what a trillion is. It's just that it's a lot, okay? But it gets worse. We have over $100 trillion in off-balance sheet liabilities. Your listeners, your age, might not know what an off-balance sheet liability is. And if you look at your screen and see me, you can see one. Medicare, Medicaid.
You mean that old guy right there?
That's right. I'm an unsecured liability. I voted myself a bunch of cool benefits, and I'm leaving you to pay for them. Now, I'm making fun of myself. The truth is that this is a social phenomenon. But I'm strictly speaking not your enemy. What I am is a personification of the fact that we have voted a wide range of entitlements with no way to pay for them. So now we have $120 trillion plus in federal liabilities, to which we have to add state liabilities, local liabilities, and underfunded pension funds. So on the balance sheet, of course, this is the right-hand side, the debt. Now you service this debt with the national income, which at the federal level is taxes and fees less expenses. The problem is that the national income is in brackets. It's a deficit. This year, before the coronavirus, the deficit was estimated at $1.5 trillion. Your younger listeners who have more recent exposure to mathematical education need to ask themselves what the probability is that you can add a column of negative numbers and come up with a positive sum, let alone a sum sufficient to retire $120 trillion in liabilities.
I think the only probability of it is if you follow your drinking binge with that extra shot of vodka and it somehow convolutes the numbers.
Well, I've tried it. So that's the first part of the equation. We're talking about faith in the US dollar. The second part of the equation is artificially low interest rates. If US dollar savings in US government securities, which is how they're managed, become more risky because the aggregate debt grows, and because it's difficult to service them, I'm being polite, with the national income, what is the compensation for the risk? Well, the compensation right now in the US 10-year Treasury is about 20 basis points, 0.2%. My friend Jim Grant describes this as return-free risk. If you think about return-free risk, it's not a particularly attractive proposition. And so the conjunction of the fact that the debt is basically unserviceable and that we're monetizing it, in effect, with printing new fiat currency out of thin air, at the same time that the bond yield is unsustainably low, what you're saying is that faith in the purchasing power of the US dollar will decline. In every past circumstance in US history, except for when gold was price controlled, that resulted in higher gold prices.
So macro view now should make sense to every single person. As you said, historically, every time this has occurred, gold price has increased, and thus the companies that mine it out of the ground have tremendous leverage to the price of gold and have great looking businesses. They have great looking earnings reports. And with oil being low, obviously that even increases profit margin and decreases operating expenses. Where are you deploying the majority of your capital within the precious metal space? Are you focusing on top tier companies? Are you focusing on juniors? Are you looking for things that are $1? What are you looking for?
In this case, do as I say, not as I do. I already own the very large gold producers.
Okay.
People who are new to the industry should begin by buying gold, not the gold stocks, because gold moves and then the gold stocks move later. It's important to know that. You will not get immediate gratification in the trade. But buy the biggest and the best. I'll name some names. These aren't recommendations. These are illustrations. Mm-hmm. Franco-Nevada, Wheaton Precious Metals, Barrick Gold, Agnico Eagle, high-quality companies that make money come hell or high water. What you, and maybe we can link later on to an offer that I'll make your listeners.
Cool.
If you look back over 45 years of gold stocks, and I have a chart which illustrates this, what you will see is that gold stocks are extremely volatile, really, really, really volatile. There have been 8 recoveries in 45 years from oversold bottoms. We're in the 9th, I believe, now. And what's interesting, what the chart will show you, is that these recoveries have generated returns in the index, not individual stocks, in the index that vary between, I think it's 180% on the low side and 1,200% on the high side.
Wow.
Young investors make the mistake of taking too much risk to outperform an index that already gives them all the rewards that they could possibly want. So what I would suggest is that buy the best stocks that you can so that you de-risk participating in this recovery. Buy the very, very, very best. After you've educated yourself so that you can begin to make valuation decisions and look for what we described before, the delta, the difference between value and price, then you can come down the quality trail. Because I already own the big stocks and I already own gold, and because I've spent 45 years learning how to make these valuation decisions, I'm doing something different. I'm looking at companies where I believe are more deeply undervalued, where I'm assuming more risk, and where I understand that my reward will take place later in the recovery. The first reward will come as more precious metals people up their exposure to the sector, and they will do it in the best of the best companies because they're expressing fear.
Okay.
The second circumstance that will happen is that the generalist investor will begin to come into the gold stocks, and they will look for the very largest capitalization stocks that they can. In other words, the biggest and the best. Once those have moved, you'll get a sympathy move in mid-sized producers. And then finally, greed takes over from fear, and you'll see the smaller producers and the juniors start to move. But it could easily be 18 months before the types of stock that I'm buying today begin to reward me.
Give me some examples of some of those smaller illustrations, or give me an illustration of some of those smaller types of ones that you like.
Some of the names that I personally have been buying include my employer, Sprott Inc., where I'm already the largest shareholder. This is not a recommendation, by the way. Right. This illustration. Sprott manages precious metals investments on behalf of about 220,000 investors worldwide. And I suspect that because of our brand name, that we will do well in a precious metals recovery. And while we wait, it pays me a 5% dividend, covering any time value of money objection that I might have. Although I don't need dividends, I like them. My friend Doug Casey describes dividends as outward manifestations of inward grace, which is a phrase that I've always loved. Moving beyond ours, there is a royalty and streaming company. That is a company that doesn't have operating interest in gold mines, but rather economic interest in gold mines, called Sandstorm. Very, very high quality company. I know the people well. I was actually one of the founding shareholders. It's been marked down in the last 3 months about 40%, which feels like a sale to me. So I've been buying a bit of that. A company called B2 Gold, a Vancouver-based company that operates a world-class asset in West Africa called Fekola, run by a guy named Clive Johnson, who I'm embarrassed to say I've known for longer than you've been on Earth. So I know him and love him and trust him. I've been buying that, but I've been buying a smattering of them. The other thing that I should mention, well, I probably shouldn't mention it, but I'm going to anyway, is that after gold is moved, silver usually moves, but it moves further. And the silver stocks move the furthest of all because they're so rare. Towards the end of a precious metals bull market, when animal spirits are really aroused and silver moves, the amount of money that tries to go into the silver stocks, a limited number of high quality stocks, is analogous, again, quoting Doug Casey, to siphoning Hoover Dam through a garden hose. The higher quality silver stocks, which would include Wheaton Precious, but more focused on names like Pan American Silver, are names that you shouldn't expect immediate gratification from because you won't get it. The silver has to move. But if history teaches us anything, when they move, the moves are really ones for the record book. So I have also been adding silver exposure. In my particular case, and these are not recommendations, Pan American Silver, Mag Silver, which isn't even in production yet, but is under construction, and Silvercrest, which is in the advanced exploration stage. This is something that you do if you are both financially and psychologically anti-fragile. You will be exposed to real risk. You will also be exposed to volatility. And almost certainly your time preferences will be tested. These are not stocks that'll move by Easter.
When do you think we'll see a more significant move? Obviously, you're not a fortune teller and there's no way to know for sure, but what are you looking at?
I honestly have no answer. What I've learned in my own life is that although people have time preferences, if you ask yourself a question where the answer is probably when rather than if, you've asked yourself a good question. So while I can't tell you if I will get gratification in 6 months or a year or 2 years, my belief is, given the probabilities around precious metals in the economy, that I will get the move. While the time is uncertain, the outcome to me seems very highly probable. Too often, people, because of their time preference, ignore financial questions where the answer begins with when. And they default to asking themselves questions where the answer begins with if. When questions are always better than if questions when it comes to your money.
Interesting. So I think you might find this interesting, and I think it's something you've probably seen for the last however many years you've been doing this. Would you say 40, 50 years or something? So my mom's boyfriend is and has been for his career. He's done, very well for himself, top 1%, but mainstream wealth advisor. Mm-hmm. Bought all, Apple, Microsoft, all those types of things like that, right? And, he's always looked at me a little bit sideways with my interest in precious metals. And my mom has thought I'm insane as well. And especially with, how much I went in on my net worth into this. And actually in the last week, my mom and his name is Jim are both now really, whoa. And Jim keeps sending me all these gold articles by Zero Hedge and all these more mainstream sites. And he just sold out a bunch of his equity positions in, growth and tech and mainstream stocks. And basically, probably for the first time in his career, says, I'm not going to buy this recovery. This is a BS recovery. And he wants to go all in on precious metals, which is like, it's like, I'm like, it's the most opposite person that I would think would ever be interested in it, but he's also rational. So after a while, just being able to rationally look at it and then seeing during the Great Depression that home stake mining was the number one stock in the entire stock market after or during the Great Depression. You can correct me if I'm wrong. And so I thought that was really interesting to see that almost slow mass awakening, which I'm sure is what occurs in the early stages. That's when you start to see the signs of the bull market in precious metals starting to accelerate, I would assume. What are your thoughts on that?
Well, I think what you say is correct. I hope that neither he nor you go all in on precious metals. I believe precious metals are a tool rather than an answer. Mm-hmm. And there will be a point in time, certainly 2 years out or 3 years out, or maybe sooner, if we have a much steeper share price decline, that I will return some of my capital to the broader stock market. One of the nice things about precious metals, frankly, is when they respond so well that if you hold them as insurance, a little bit goes a long way. 10% of your portfolio in gold in the year 2000, as an example, would have, the gold price went from $250 to $1,900. A little bit goes a long way in a bull market. So you don't need to be overexposed. But let me tell you, and I'm not going to give you an answer to where it's going to go. I'm just going to give you some tools to think about. I read not too long ago a study from a big bank, I think it was JP Morgan, but I'm not sure, that the market share of precious metals and precious metals related investments in the US among savings and investment products was between 1/3 and 1/2 of 1%.
Wow.
That is to say, in the United States, between 1/3 and 1/2 of 1% of savings and investment assets nationally are in precious metals and precious metals related investments. In 1981, the top of the last bull market, the similar number was estimated to be 7%.
Wow.
More importantly, the 3 or 4 decade mean is between 1.5% and 2%. So you don't have to believe that gold is going to supplant the US dollar or that we're going into the Greater Depression. All you have to believe is what I believe, which is to say that given the current level of economic uncertainty, gold and precious metals will revert to the 3-decade mean. Because if they revert to mean, demand for precious metals and precious metals related assets will grow between 300% and 400% in an economy that is by itself 24% of the world's investment and savings assets. If you thought then about the potential for price appreciation, both in physical precious metals and in precious metals related equities, in a circumstance where their market share grew 3-fold or 4-fold, you get some idea for the potential that these investments have. And you get some feeling for how much of an impact on your portfolio a relatively small investment in the sector could have. An affordable investment, I would suggest, for somebody your age.
It is affordable. That is something that I, and as you said, especially given that we're at whatever 1/10 of 1% of the market share, things are really affordable. One thing that I really appreciate about you is that you are able to keep your emotions out of things. And being someone like myself that's, has a large audience online, I see so many comments, emails, and messages. And so I, in conclusion, I know your time is valuable, and this was an incredible interview with a lot of great stuff. I wanted to ask you what advice you have to people that think that the world is about to end, or any second now someone's going to come in with an AK-47 automatic and just start robbing everyone, or everyone's going to be a jobless forever, or you're never going to get a job again. And there's a lot of there's so much emotion. And so in conclusion, I guess I just wanted to step away from the financial aspect and something that I think you would agree with, and probably a lot of the people that know you well would agree with. Something you have done tremendously well is do a really good job of managing your emotions. And so in conclusion, I was just hoping you would offer any thoughts to anyone going through a tough time right now, or is very pessimistic, et cetera, et cetera.
I would say this: the next little while is going to be tough. So prepare yourself for that. We're unwinding a 10-year recovery. And the way that you unwind a recovery is with a recession. And a recession will be tough on society, and it'll be tough on individuals. This recession, I think, will be tougher because people of every generation, yours and mine, have come to rely on other people, governments, for the solution. And the solution to our problems is ultimately ourselves. We over-dramatize the importance of things that are happening to ourselves personally on society, however. There are other generations that have had challenges. World War II, as an example, might be considered to be a challenge. Before that, the Great Depression might have been considered to be a challenge. The truth is that once we go through this reckoning, as I see it, we will come out the backside less fragile as a society, and less fragile as individuals. The truth is that every generation of Americans, at least, has had it better than the generation that came before them. Your generation may be tested because of all of the benefits that my generation has voted itself at your expense. But it's something that you're going to have to deal with, either by voting those benefits out of existence, which I think you're perfectly right to do, or by some other method. But the truth is that to the extent that you learn your lessons and you learn to generate for others, you'll come out of this just fine. Maybe not in 2020 or 2021, but the truth is that you'll come out of this just fine. As I think I told you in coming out of the period of the 1970s, the decade of the 1970s, I, as an investor, confused a bull market, which is what we were in resources, with brains, which is what I thought I had. And I didn't. And when the commodity prices collapsed, I went from being a wealthy young man to having a negative net worth. It was extremely unpleasant for me and inconvenient. But the truth is, the lessons that I learned as a consequence of that are what is responsible for my position today and my net worth today. And it's also responsible for the fact that I've been willing and able to help thousands of investors avoid some of the mistakes that I made. The point of all this isn't autobiographical. It's simply to say that you should expect hard times to come to your life. You should expect to work through them, and you should expect to work through them yourself. And the lessons that you learn as a consequence of that, and the way that you conduct yourself in the future, will be benefited by the tough times that you're going through today. I realize that's not the advice that anybody wants to hear, but it doesn't matter much because it's true. Second thing is, to the extent that your listeners, young or old, are already invested in natural resource stocks or in precious metals, I would be delighted if they wanted to rank their natural resource portfolios. Any of your listeners, big or small, young or old, who want a little personal handholding can email me their natural resource portfolios. It's important because I'm an old, inadvertent Luddite that is not technologically competent, that the email include in the text, not as an attachment, the names and symbols of the stocks that are held. For people, well, for both, for the people who want their stocks ranked, I'll rank them 1 to 10, and I'll comment on stocks where I think my comments have value. But I will include in the return email that 45-year Barron's Gold Mining Index chart and also a 100-year commodity chart, which will make the point of precious metals and commodities valuations over time. If people just want the charts and don't have any stocks for me to rank, I'm perfectly happy to send the charts. The email address is rankings, RANKINGS, at Sprott Global, SPROTTGLOBAL.com. That's rankings at SprottGlobal.com. I will rank investment portfolios, and I will include the two stock charts, send them back by emails. Your listeners, whom I know to be numerous, will have to be patient because I do this myself. It'll take a while responding.
I'll put the email too in the description too. So if somebody didn't catch what you said, I'll copy and paste it down into the description for people.
Great. It's important that people understand that this isn't investment advice. These are just rankings. And the charts, I'm no technical analyst. What they really are is illustrations for the conversation that you and I have been having.